Hello and welcome into the KE Report. Chad and Corey here as your host, and today we're getting an update with Arizona Sonoran Copper. Arizona Sonoran Copper is traded on the TSX under the ticker ASCU and on the OTCQX under the ticker ASCUF. We are joined today with the President and CEO of Arizona Sonoran, George Ogilvie. And George, always great to have you on the show. We were checking before we started recording here today, and it's been since April since we've had you on. So even though we've caught up at different mining conferences and kept in touch through email, this is the first time we've had an update here really since the spring. And it's really to focus in on the PFS that you put out to the marketplace on the 19th of November. Now, we've talked about a PFS and a PEA in the past, so just to bring people up to speed, this PFS is on the simple open pit model. Once you found Mainspring, everything changed, and it changed the way you could approach developing this project from a high level at an NPV with an 8% discount. This is a US $2.3 billion project with an internal rate of return of 22.8%, which is a lot higher than a lot of other copper projects. A long mine life. There's a lot to get into here. Let's dive under the hood. George, what are the key takeaways you want investors to have from this PFS?
Well, I think the key takeaways, Shad, are, we've really tried to simplify the mine plan, first of all. So in this PFS, there are two open pits that will be mined over the 22-year mine life. In the first 16 years, we're mining Park Salyer, which really is the driver of the production and the economics. And then in the mine's latter years, when Park Salyer, the production starts to wane in and around year 14 and 15, we go over to Cactus West, which is the old Sacaton mine that was formerly mined here in the 1970s and 80s. And we do a pit layback there of the existing open pit. And that we mine that essentially for the next 5 to 6 years. And that's ultimately what gives us the 22-year mine life. So we've taken out the primary sulfide, we've taken out the underground component at Cactus East, and even the surface stockpile as far as going on the leaching pad and recovering copper is not in this plan. And of course, that presents a lot of optionality and opportunity going forward that, once the mine is actually in construction and development and in production, we'll then be able to come back and look at those opportunities and probably further increase the life of mine or the economics of the project at that juncture in time.
So, George, with this almost simplicity that you're going for in this asset, does that change the permitting timelines? Does it make permitting simpler for this project?
No, it doesn't, Corey. It was already relatively simple. And as the listeners may remember, because we're on private land here, there's no federal nexus. So in Arizona, when we make applications for amendments to the permits, once those applications are administratively accepted, it starts a clock ticking. And within 6 months, the regulator, both at the state level and or the municipal county level, must give us a response to our permits. So we're currently making out those applications as we speak. And we believe that by the end of January next year, the applications for the amendment to the Aquifer Protection Permit and the amendment to the Industrial Air Permit would have been accepted. And that clock will therefore start ticking. And you can therefore see that by June or July of next year, we'll be in possession at that time of the final permits that would allow us to construct and develop this mine as per the plan presented within the pre-feasibility study.
Well, George, just diving into the process here, I think we've talked about this before, but for new listeners or for people that are just now waking up to the story because of the copper price doing so well and they're looking for domestic copper projects, things really changed as far as the modeling on this project once you had Mainspring in the mix, which is a relatively new addition to the company, and the ability to treat it all as a larger pit with Park Salyer. Maybe talk about that breakthrough and how you shifted from underground to open pit and how this project became that much easier to work towards, and then you can kind of drift down into Park Salyer from Mainspring.
Yeah, so I think it was in early 2024, we put out a pre-feasibility study. We had not taken legal title at that time to the Mainspring property. So we were looking at the original Park Salyer then as an underground sub-level cave operation. Obviously, underground mining, it comes with higher operating costs and higher cutoff values. And it did obviously present some risk given it's underground mining in Arizona, which is not typical. When we picked up the Mainspring property, which essentially is the southern extension of Park Salyer, but the mineralization trends towards surface, once we picked that property up from a private landowner in the second quarter of 2024, we were then able to look at mining Mainspring initially as an open pit, where the mineralization comes to surface within 42 meters or about 150 feet. Whereas at Park Salyer, the mineralization is about 300 meters or 1,000 feet below surface. So we start with the shallow mineralization at lower grade at Mainspring, and then as we advance the open pit to the north, we get into the higher grade material at Park Salyer, where there's some areas where the grade is in excess of 1% copper, which by today's standards is quite high for an open pit. With open pit mining, it allows us to have lower operating costs, less execution risk. Lower operating costs means that we can lower the cutoff values of where we see the deposit is economically viable, and that brings more mineralization into the plan. So essentially, we doubled the production from 58,000 tons of cathode a year to over 100,000 tons of cathode production a year. And at the same time, we've de-risked the asset because open pit mining is certainly a lot easier to undertake than underground mining in Arizona.
Let's talk capital costs then. Look, the initial capital expenditures, little less than $1 billion, $977 million. That's US. Sustaining capital at $1.3 billion. I'm seeing a payback period here, base case being just over 5 years. That encompasses a 24-month build time. Just curious how you want us to view this, because I'm also seeing that you're estimating that average cash flow from this is around that initial capital expenditure cost. It's a little under $1 billion a year. It's actually almost the exact same as the capital expenditures. So how does this compare to peers? Give us a lay of the land there in terms of the money it'll cost, payback time, and again, how this compares to other peers.
Well, I mean, with upfront capital of 977 million US dollars, it's actually a very low upfront capital compared to other peer, near-term copper development projects in the Americas. When we look at it on a capital intensity basis, which means how much upfront capital do we require per pound of copper cathode actually produced, on this one, we're actually sitting at just under $11,000 a tonne, which actually puts us in the first quartile of the lowest capital intensity projects actually in the world today. And what allows us to have the capital intensity so low, or the upfront capital, is that we're in a jurisdiction that's very infrastructure rich. So what I mean by that is that we have access to roads, we've got access to rail. There's a main power line that runs through the site. We have access to water because the city of Casa Grande is 5 kilometers to the east and southeast of the project. We don't have to construct a camp. Typically, when deposits are found and mines are being developed, they won't have access to roads. There won't be any water. There won't be power lines. So all of those things have to be actually brought in, and it drives up the upfront capital. So we're able to leverage the infrastructure in the area, which keeps the upfront capital low, and therefore the capital intensity is one of the leading edge, near-term copper development stories in the world today.
Yeah, George, and I think a lot of people will also be familiar with one of the mining giants next to you, Robert Friedland's Ivanhoe Electric, where they're also moving forward with the development of the project, which is similar. Anything you want to say as far as the comparables between the valuations? And the only reason I ask you this is that I have a lot of people that email me and ask, what is the difference here? Why is there such a gap between the two
Yeah.
valuations?
Yeah. Well, look, I mean, the Santa Cruz deposit, which is what Ivanhoe has quite literally across the road, essentially is the down plunge extension of the same mineralized system that we are mining. There's a horse and graben fault quite literally on the property boundary, which thrusts their mineralization down an extra 300 to 400 meters. And on our side of the property fence, obviously it's much closer to surface and even outcrops on surface. Their grades are better than ours, are higher, but obviously it'll be an underground mine and it comes with higher operating costs and higher execution risk. When you're comparing the valuations of the two respective companies, you have to be very careful because they're not strictly apples to apples comparisons. Ivanhoe Electric is a multi-asseted company. They have other projects throughout the world. They have some advanced technology called Typhoon that allows them to do deep penetration when they're actually exploring for base metals or conductors in the ground. They've got some of the Saudi sovereign wealth money in there with Madden. And of course, they've got the Robert Friedland as the chairman, who's had quite a wonderful and remarkable career. So when you factor all of that together, that's really what drives the Ivanhoe Electric valuation that's multiples higher than where Arizona Sonoran is and the Cactus Project. Now, in saying that, when you compare their project to ours, we still think that we're still significantly undervalued. And despite the share price, being up 180% in the last 12 months, we still are only a 600 million US dollar market cap company on a 2.3 billion NPV 8 after tax project. So in our mind, we're still trading at under zero point 0.3 times price to NAV, and most of our peers are trading between 0.6 and 1 times price to NAV. So we think that this year has been very much a catch-up trade. And as we continue to deliver on our objectives in 2026, we think the share price is going to continue to re-rate over the course of the next 12 months.
So talk to us about the strategy then, George. Do you go down the road of trying to finance this thing? As you said, you're 600 million. I'm seeing about 550 million US dollar market cap right now. You do need to raise that close to $1 billion just for initial capex. I'm not seeing a whole lot of other metals in the mix here, so I'm not sure if you have an option or a royal or a stream option here, but talk to us about if now you look at project financing or if there's other kind of tweaks to this project and to the economics that you do first.
Well, it's a great point. The project financing process has started. In August of this year, we engaged a group called Hannam and Partners out of London in the UK to act as our project financial advisor, particularly with respect to the debt component. We approached 15 groups in September, consisting of ECAs, commercial banks that still lend in our space, and some of the private debt lenders. All of them signed an NDA in early October, and they've been in the data room ever since, just conducting some high-level due diligence. We've received some preliminary term sheets. The plan of action in the first quarter of next year is to receive additional term sheets from some of the other groups that haven't provided those as of yet. We'll then assess those term sheets, and then our plan is to bring in the independent engineer in the second quarter of next year. And then as we complete the final amended permits, which we touched on earlier, as we deliver a definitive feasibility study in the second half of next year, we would hope that the independent engineer would get comfortable with the project. Ultimately, we would receive term sheets from those groups, which will narrow down from 15 probably to 4 or 5 in the early second quarter of next year, which will be the main project syndication group. And we would hope that we would receive those debt term sheets from them sometime in the late third quarter of 2026. Once that's in place, then the way it works in our industry is we then have to turn our attention to the equity and or other forms of financing. And on this project at the moment, there's been no offtake that's been awarded. So obviously that could be one of those other forms of financing. And then we would anticipate moving into 2027 that the equity and other forms of financing would be in place. And ultimately, we would draw on that throughout 2027. And then once that's fully drawn and 100% of the detailed engineering is then completed, we would then be able to draw on the debt component as we moved into 2028. When we look at this project and we stress test it down to $3.75 a pound of copper, because some of the commercial banks are still very, very conservative, and that's their floor sort of copper price. Even at those levels, we see that the project is financeable, and that's on a 60 to 40% debt to equity split. So, in simple math, at $1 billion US of upfront capital, that's $600 million US in debt and $400 million US in equity is what the ask would be based on the current PFS.
Well, George, it sounds like you're narrowing down the term sheets, like you say, for next year for the debt component. It's still a defensive project at much lower copper prices. I think we should also point out the converse of that, though, too. I've got your slide deck up, and when I look at where we're at, I mean, we're at 530 to 540 a pound copper this week as we talk. At $5 a pound, the NPV 8% post taxes 3.3 billion, and at 550 a pound, which is we're pretty close to that, it's at 4 billion. So think about the dynamics there on the metal sensitivities. But I also want to bring another thing into this capital stack, and that is that we talked last time in April, you had just bought back 1% of the Bronco Creek exploration NSR, and you made the point that the Mainspring property area doesn't have a royalty on it. Could you, with some of the NSRs that you bought back from, also from, I think, Royal Gold and Elemental, could you resell those royalties again, or could you put one on that Mainspring? Is that an option you have?
Yeah, it's definitely an option, Shad. There's no doubt about that. That would fall into that other financing option category that I touched on earlier. It would be fair to say, however, that it's not our preferred route. The less streams and royalties that are on projects, the better, because ultimately those monies can actually go to the shareholders' pocket or the share value or in dividends and not to the royalty company. So it's definitely in the mix, but it's really, really low on the totem pole, I would say, as far as options for financing this project. And look, the beauty of this project is it's got a plus 20-year mine life. So when we look at all of the debt service coverage ratios at $3.75, this project looks extremely attractive. And what's going to be attractive to the lenders is that if we're looking at 8 to 10 years of tenor on the debt, once you go beyond year 10, you've still got another 10 years of mining, which will be extremely attractive to the debt lenders. And that gives them confidence that even if things really, really went badly, they're absolutely going to get their money back. And as you pointed out, at $5 and $5.50, which is in and around where the spot price is trading today, the economics on this project are just off the charts.
So, George, as much as we've talked about how you're going to raise the money to build this asset, let's talk about the most recent financing that you just closed for a little over $86 million. That's Canadian. That was a bought deal financing. Look, we've talked a lot about how this market is, the financing door is open. You clearly took advantage of that. What's the significance of bringing in this chunk of money?
Yeah. Well, look, prior to doing that raise, we communicated to the market that we were fully funded to a final investment decision in late 2026, which is still true. Had we not done that most recent raise that you referred to, we would have closed out the year with just under 50 million Canadian dollars cash in the bank and would have been well funded for 2026. The reason why we did the raise was with the PFS, when we went out for quotes on the plant and equipment, one of the things that we noticed over the last year was that the timelines for delivery of some of the key critical components were actually being pushed out upwards of a year to even 15 months from what we saw just a year prior. Now, had we not did this raise and we completed the definitive feasibility study, because there's more than a 6 month gap between the PFS and the DFS, we would have had to go out and actually get fresh quotes for the DFS on the plant and equipment. And if those timelines in the second half of this year are going to be further pushed out, it jeopardizes first copper cathode in the second half of 2029. So when we were approached by one of the banks who had a lead order, I might add, for 150 million Canadian dollars from one institution, when we discussed this with the board, we determined that we should be opportunistic, take some money off the table. Obviously, we didn't need 150 million. We cut that down to 75 million. We told this one institution that we didn't want them to be above a 10% shareholder, so we scaled back their order. But essentially, the book was filled before the deal even went live. And we took the money off the table because as we're now developing our budgets for 2026, we've got the ability to consider what we call an early works program. This still needs to be signed off by the board next week at the budget meetings, but it allows us, if we so choose, to make some commitments to start some early activities, which will allow us to keep the schedule intact for first copper cathode in the second half of 2026. And that's why we were opportunistic and we came to the market with that deal. And we also brought in a brand new blue chip institution that obviously is a strong supporter of the management and the company.
So, George, as much as we talk about prices here and now, this asset isn't going to be in production in, let's say, this year, even next year, even in the next couple years. So what can you do to keep this momentum going with the stock? The stock has performed so well this year, but you're not in that development phase yet. So how do you keep the interest and the momentum moving forward here outside of just an increase in copper price?
Well, I mean, there's some key deliverables next year. Obviously, there's a definitive feasibility study which we've now embarked upon, and we intend to deliver that to the market in the second half of next year. Obviously, the confidence levels in a DFS is higher than a PFS. So if we're able to duplicate these results in a DFS compared to the pre-feasibility study, I think the market, can start to consider a higher PNAV multiple as the analysts get more and more comfortable that the asset is being de-risked. I think a big de-risking event for us next year in the eyes of the market, not for me, but in the eyes of the market, will be gaining those amended permits that are required to actually construct and develop the mine. That's probably the largest gating item for the market. And I think once those are in place in the summer of next year, there's a big opportunity for an uplift in the project with those final permits actually in place. And then I can't really go into the details today, but obviously there's things going on within the company strategically. We've been approached by some of the end users of copper that are looking to gain access to the metal so that they don't have to rely upon it either from external sources, which ultimately, puts the supply chain in danger, or potentially could, fall under future tariffs if the Trump administration starts to look at that again and puts tariffs on the finished copper product. So, if we saw something next year where there was some sort of MOU or LOI coming out with Arizona, Sonoran, and a world-class organization, I think the market would look at that very, very favorably, that we're aligning ourselves with, end product users. And I think that would be taken extremely well by the market.
Well, George, I think we'll wrap it up there for today, but very well stated there as far as the different value levers for next year. In addition to potentially a higher copper price, what nobody knows, but it's trending higher, you have the DFS coming out, you have the permit milestones, you have the term sheets that you can start working on mid-year and announce to the market for the capital stack. And yeah, if you had an offtake agreement with an LOI or an MOU with a major metals buyer, that would definitely de-risk the project further. So a lot going on with Arizona Sonoran. And so for those of you listening in, if you want to follow along with all the news flow in the year to come, definitely click on the link below down in the show notes. It takes you right over to the Arizona Sonoran website, straight to their news section where you can have updates hit your email inbox or just follow along with the news as it drops. You can always send Corey and I a question. We'll relay it over to the team or send a question directly into the team. And there's a lot going on as far as catalysts for 2026. So George will definitely be getting you back on and keep following along with it here at the KE Report. And as always, looking forward to our next conversation.